So time value of money. So this is basically the definition of time value of money. Can you read, Ramesh? So basically, you are given a choice if you want to receive the money today or after 3 years. So what you are going to prefer? Basically, what will be your preference? You would like, suppose I say I'm going to give you a lakh rupees, Ramesh, after today, or I'm going to give you the same money after 5 years. So which option are you going to choose today or after 5 years? Today only, because the money has potential to earn. So you can put that 10 lakh rupees and earn interest on that. So which will be much more than the money which I'm going to give you after 5 years. So because people will always prefer the money today and not later. If there is a choice given, a person will like to have the money immediately rather than in future. Okay, so this is a normal kind of a thing. So basically, this is the core principle of finance, that the money can earn interest. If you receive money, you can put it, in an investment, in a fixed deposit, or anywhere you can invest. And money is worth more, if it is received today rather than, at a later point of time. Okay. So, it's quite explanatory that if you receive the money, you can just put it in your, in an account and earn interest on it. Either it's a saving account or a fixed deposit, so or any other form of investment. So you are going to, earn interest on that. So that's why, it grows. Okay. So, this is a very simple thing we are all familiar with. So if you have 100 rupees and you put the money in a bank, if it is giving you 5%, then it will become 105. So what you do is you take 100 and multiply it by 1.05. So, if 100 rupees is received after 1 year, it is equivalent to 95 rupees 24 paisa. How you get it? You take 100 and divide it by 1.05. If 5% is the interest rate, if you divide 100 by 1.05, you will get 95.24. So, I mean, just it's a simple thing, but I'm just going to, show you this calculation. So, if you take 100 bucks and divide this by, 1.05, fine. So it's 95 rupees 23 paisa today. So any money which is received after 1 year, if you earn 5% on it, so you divide by 1.05, you will get the present value of that money. So 100 received after 1 year is equivalent to 95 rupees today. So if I give you a choice that, I'm going to give you, say, 50,000 rupees after 1 year. Okay. But a choice also that you should, I'll give you equivalent amount of money today, the present value of it. Suppose if you're earning an interest of, say, 7% on your fixed deposit, so which means that you can, if I give you 46,728, it is, you will be happy because you can put that money in a bank and it will grow to 50,000. Isn't it? Ramveer, whenever you put your money in any investment, so you make sure that it beats the inflation. Suppose the inflation is 6%. So if you're earning 7%, it is beating the inflation by 1%. Okay, but the fact remains that 50,000 received after 1 year and 46,728 rupees today. If you can earn 7%, then it is equivalent. So you will prefer the money today, receiving 46,000, no matter your money is getting beaten down by the inflation. But if you are earning higher than the inflation, you will always like to park that money, okay, so that it earns interest. Okay, fine. So Ramveer, that's a good observation. So let's go forward. So what all we are going to learn, during today's lecture, and I'll try to complete everything today so that we can start a new chapter. So today, we are going to calculate what is the future value. The first will be for a given amount, what will be the value, or we learn art of compounding. Okay. Then future value of a single cash flow. Suppose, I tell you that you're going to receive, 1 lakh rupees today, and you're going to put it, say, at 6% rate of interest. How much it is going to become, say, amount after 5 years or 10 years. Okay. So that is a future value of single cash flow or future value of a lump sum. Okay. So it's the same thing. Then future value of an annuity. Suppose there is an option to receive the money in installments. Suppose I give, you get a money, 5,000 rupees every year or 5,000 rupees every month, and you deposit that money in a bank as a form of recurring. and for 5 years, how much that money will grow. Okay, so we learn all the formulas so that it becomes very easy for you to calculate. Then a sinking fund factor. This is very good. Suppose, for example, you want to buy a house, say after 10 years, and you know that the house is going to cost you about 10 lakh rupees. So how much money you should save today every month at a given rate of interest so that it grows to 10 lakh, say over a period of say 10 years. Or in case of your companies where you're working, companies replace their assets, their plant and equipment, machinery. So they always keep some money for replacing your old assets and buying new whenever they become obsolete or they become worn off. So they always create a sinking fund where they're going to park the money every year out of the profits so that it goes to the amount where you can replace those assets. So we learn how much money you should deposit every year if you're earning a certain rate of interest, so that it will be equal to the amount that you can buy a new asset from it. So that's called the sinking fund. Okay, so we learn that. Then the second concept is most important. Is called the present value. So it is also called discounting. So we are going to discount. Suppose I tell you that you're going to get a lakh of rupees say after 5 years. So if you prefer to receive the money today, so you are going to discount that lakh of rupees or 5 lakh rupees which I'm going to give you, and tell me that this is the amount you pay me right now. So I'll be happy so that I can earn and make it 5 lakhs in next 5 years. So this is called the present value. So if you have an option to receive the money in future, or you to receive the money today, the same amount at a discount rate. So we will calculate how to convert the present value of that future cash you're going to receive. Then present value of a lump sum. So this is what I've talked about, that you're going to receive say 10 lakh rupees or 15 lakh rupees after 10 years. So what is the value today if it is given to you? So present value of an annuity. Again, if suppose you are going to receive, say 1 lakh rupees per annum for next 5 years. So you want to know what is the value today. If I receive all this money in one lump sum today, what should be the value? Okay. So present value of an annuity. So we are going to understand all these concepts and do a lot of questions on that. Then, the most important one is the EMI calculations or capital recovery factor. Suppose you happen to buy a car. Okay. The bank says, they are going to charge you say 7.5%. And you have to pay the money in 5 years in equal monthly installments. So you want to calculate what will be your EMI. So we will understand how to do that also. Then the key concepts. Can you read, Ramesh? So this is yeah. Okay, read. So the first one was be able to compute the future value of an investment made today. Suppose you are making an investment, okay, and you are going to earn some say 8% or 7% interest on that. So how much it will grow to amount after say 5 years or 10 years when you complete your investment period. So this is one. Then be able to compute the present value of cash to be received at some future date. Suppose I gave an example. Suppose I want to give you a couple of lakh rupees, say after 20 years. So, what is the present value of that 20 lakh rupees? Okay, fine. So that we will know. Be able to compute the return on an investment. So all the time, you are looking at, what is kind of investment you are getting. Suppose somebody says that a bank says or an investment company says, give us 5 lakhs and we will give you say 20 lakh rupees, say after 3 years or after 5 years. So you want to calculate what is the return I'm getting. Okay. So this will be another. And again, for your business needs, you have to calculate, what the return you're getting on the equipment you're buying, and putting it for your production. So how much return you're getting from that asset. Okay. Read further. This is very interesting. Okay, I'll explain all this through examples, and you will learn that. So this little bit of theory, be able to compute the number of periods that equates the present value and future value given at interest rate. Suppose I say that I'm going to give you 25,000 rupees, per annum for next 10 years. Okay, you give me 1 lakh rupees today. So in 10 years, I'm giving you 25,000 rupees per annum and just taking 1 lakh rupees. So you want to know what is the interest I'm giving to you. So be able to compute the number of period that equates the present value, which is 1 lakh rupees which you are going to give me, and I'm going to give you 2.5 lakh rupees, say after 25,000 rupees every year. So you want to calculate what is the interest rate I'm giving you. So this is one. Okay. So, mostly we will be using Excel sheet, and in exam, I'll allow you to go to Excel, okay, and use it. So you will be given permission to go to Excel and, solve your papers. So we will understand all this through Excel, okay, manually on the basis of calculator, on the basis of some tables, and on the basis of spreadsheet. So I'm going to explain everything, but ultimately it's a spreadsheet which is always used in the corporate world. So you're going to, use that. But I mean, you must understand how the value has been calculated by the spreadsheet also. So you have to know how to do it manually also. Okay. Okay. So there is always a time preference of money. Always an individual will like to have the money today rather than on a future date. Okay. So there is a time preference for the money. You would like to have the money today, and why? What are the reasons for it? Read it. So there are three reasons, why we prefer the money today. Why not, in future? So there are three reasons. First is what? The risk. Because there is a risk. For example, if I tell you that I'm going to give you 5 lakh rupees after 5 years, so God knows whether I'm going to be there or not. Or suppose you deposit your money in a company, and company is going to give you interest and return your money along with interest after 5 years, but the company can go bankrupt. Okay, so there is a risk involved. That's why we choose to receive the money today rather than in future. So we have always a time preference to receive the money today, okay, rather than receiving in future, unless we can take risk, or if we understand the risk is very less, then you are going to put the money and give the money to some company, depending on which company it is. Suppose I say that there are two companies, one is Reliance, another is DLF. Both are seeking money from you, and they are going to pay interest, same interest, say 10% per annum. So which company are you going to choose, Reliance or DLF? What will be your answer? Why Reliance? Why not DLF? Yeah. So, time preference of money, because there is less risk involved. You will try to take less risk. Okay, fine. Suppose you put your money in a government bond or a fixed deposit. There is a least risk, isn't it? Now, if you give a money to the bank, you always think that it is, least risky, but the banks can also go bankrupt. You have seen that cases, small banks going bankrupt. But if you give a money to a government and invest in a government bond, so it is called a risk-free investment. There is no risk when you give money to. Uh, I'm not able to hear you. Okay. So, but the governments have also failed. Government of Greece, you found that they were also defaulting. So there is always a risk attached to any form of investment, whether it is given even to the government. But there is a least risk, and we always call there is a risk-free investment when you put the money in a government, because government can always print money and give you money back. Okay. Like the Sri Lankan government today is facing a lot of problems, so they are defaulting on their investments or bonds which they have issued to the public. So there is a risk also, even if you give the money to the government. Okay. Second, preference for consumption, because you would like to receive the money today because you have to buy certain things. Okay, you have to run your house, you have to buy food, you have to buy a computer or a calculator or a or a telephone or a mobile. So you have a lot of consumption needs. So that's why you need the money today rather than, in future. Then, the investment opportunities. Because if suppose, you have to buy a car and you want to buy it from the money which you have saved. But if you have a great investment opportunity, if I tell you that, you are going to earn 15% in return in next 1 year by investing in a company like Reliance or Tata Motors or Hero MotoCorp, if the share is going to go up. So then, you are going to, delay your consumption for all your things which you can, and you're going to put your money on an investment. So the preference for the money, the three reasons: risk, preference for consumption, and investment opportunity. So, if you don't want to take any risk, where you will put your money? Suppose you have ₹1,00,000 with you and you don't want to take at all any risk. So which is the best form of investment where you don't have any risk? Can you tell me? Okay, others? Government bonds. See, if you look at the gold, if you go to the Google and look at gold returns, in the last 1 month, gold had touched around close to about 58,000. Now it's languishing at 52,000. So if you had put money in 1 year back, okay, so I'll just show you that. Okay, somebody said gold. So let's see whether gold is risky or less risky. Okay, so gold, rates today. Okay. So if you look at, you're getting a chart of gold, isn't it? So, at this point of time, gold was 55,165, isn't it? Where my pointer is. And today, the gold is about what? 51,805. Is there a risk in gold or not? If you have invested about 5 days back, your money would have gone down by about, close to about 7 to 8%. Is gold, riskless asset, or there is a risk involved in gold? Absolutely. Let's say 1 year. Let's say 1 year. Okay, in 1 year, the gold was, around 49,405 a year back. Then it rose to, about 54,000. It touched about 55,000, but it is still down 54,000. Though the gold has grown, over the year, fine. So it has touched, gone from 49,405 to, 51,000. Okay, so a 2,000 rupees increase, which translates about 4% return on per annum. If you double it, it becomes 1 lakh. So 4,000 on 1 lakh becomes, 4%. If you put your money in a fixed deposit, how much return do you get in 1 year's time, in last year? Any idea? If the same amount you had invested in a fixed deposit a year back, no, I am saying, even you have to pay tax on gold also. So you're equating something with that post-tax returns. On gold, you're saying, pre-tax returns. So gold also, if you, earn money and you have to file your tax return and pay interest, isn't it? Pay the tax also there also. So compare the two returns without the tax. Okay, fine. So you'll find, a fixed deposit might have given you around close to about 5.5% to 6%, whereas gold has given. Though I agree, gold is always, an asset class which is, the least risky, but not that it is not, it still has a risk. So that is what my point is basically. Have you got the point? And gold is risky because gold can go up and down. But if you put your money in, in basically in a government bond, somebody said, okay. So fine. So basically, risk-free asset would be the right answer is basically if you put money in a government bond. Okay, government is issuing bonds, every Wednesday. RBI is auctioning bonds. I'll just show you the bonds just after some time. So read this. So because you are not satisfied with about a 7% kind of a return which you get a government bond, or a 5 and a 6% return on a fixed deposit, because you want, because as somebody said, Ramveer said that there is always an inflation. Okay, so you should put your money which it can beat inflation. So, which is the other form of investment, which normally beats the inflation, which has a risk? Share market, if you invest for a long period of time, you are bound to get about 12 to 15% kind of a return. I'll show you that. Okay, in last say 20 years, stock market has given a return of 15% per annum. Okay, on an average. So if you have a longer term horizon, so you will come on. Yeah, yeah. You can invest also in property. Yeah, definitely. And it all depends. Property again, if you are living in Gurgaon or Delhi, you will find, the Gurgaon properties have, gone up much higher than Delhi properties in the last 1 year. If you have seen that. So again, it all depends, where you're putting your money. Whether you are putting your money, and you don't know which market is going to do well. Okay, but definitely Gurgaon would do better, or the, small places where, the real estate is doing good. So there you will earn more. If you invest in a matured market like Delhi, you may not get a very high return. So in Delhi, if you have invested, say, in last, say, 10 years, it's hardly grown by 1 or 2%. Okay, in Gurgaon, the return has been almost like, 50% in the last 2 years. So it all depends, where you're putting your money, and it's a risky game. Okay. So again, the same thing is true for the stock market. Okay. So then, what is your required rate of return? First is that you are first of all, you should get at least the return which is equal to the risk-free return. If the government bond is offering you close to about 7% return, so that return you must earn. If the risk premium is more, you're going to get more return because investing into, a risky assets. So it should compensate you above the risk-free rate. So your total rate of return should be risk-free rate plus the risk premium, depending upon, which asset you are earning. So first thing you must know that if you are putting your money, you should get at least 6 to 7% of return, because if you invest the same money in a fixed deposit, you're getting 6%. Okay, but if you given in a government bond, it's also giving you the same return, but that is called the risk-free rate. So if you are investing, so your return requirement should be risk-free rate plus the risk premium, depending upon which, how much risk you can take. Okay, so greater the risk, more will be becoming the risk premium. Okay, like you invest in a stock market, it gives you 15% return. So what is the risk premium? Around 7 or 8% kind of it. Suppose you are putting your money in a government bond, you are getting 7%, but in a stock market you are getting, say, 12%. So you're getting 5% risk premium by putting your money in a risky asset. So now what is a risk-free rate? Okay, as I told you, if you put your money in a government bond, which is considered to be the least risky or having no risk at all. So if you just press this option, so it will take you to a 10-year bond. Okay, government is issuing bond, for the duration of say 1 year, 2 years, 6 months, which are called treasury bills, and then they raise the money for 3 years, 5 years, 10 years. So here we are looking at a 10-year government bond yield. Suppose you put your money today in a government bond, how much return you are getting in a government bond? Can you see this? 7.318. So this is the return which you will get if you put your money in a government bond. Now tell me how much money you get by putting your money in a fixed deposit. Huh? So is the government bond giving you a better return today compared to the fixed deposit, or less? Okay. So today, nowadays, government bonds are giving you much better return than even in a fixed deposit. So you can even buy them whenever you want, or you can sell them. Okay. Even the individuals can do that. Okay. But that we'll discuss and understand later how you can put your money in government bonds. But that is not the topic. But you earn about 7%. Now, if you look at this 10-year government bond, okay, there is some data. I mean, even the government bonds, they keep fluctuating. Okay, so this is the return what we have been getting, say, in the last 15 days. If you see, you can just convert into a 1 year or something, so you can know the government bonds also keep fluctuating every day, every minute when the markets are open. So just to give you some more idea about that. Now, what is the price of the government bond? This is 94 rupees 96 paisa. If you buy it today, this 100 rupees bond which the government issued, okay, is today selling at discount. It has a coupon rate of 6.5%. So government is giving you 6.5%, but by putting your money at 94.6 and receiving, all your 100 rupees at the time of maturity, which is going to be in 2032, your return goes to 7.38. So this is called the yield. Okay, which means that if you put your money today, which the government has issued about a year back at the rate of 100, okay, and the people who applied for these bonds directly from the government, they are getting 6.5%, interest. But if you buy the same bond today, which has depreciated and today trading at a discount at 94.66, your return is going to go up 7.38 because you are going to put 94 rupees 66 paisa today, but you are going to receive 100 rupees back at 2032 along with your 6 rupees 54 paisa per annum till that for the next 10 years, because this government bond is going to mature in 2032, which was issued in 2022. So for the remaining say 10 years, you are going to get 6 rupees 54 coupon rate on 100 rupees, 6 rupees 50 paisa per annum, and which will translate a return of 7.318.